My homeowner's insurance went from $1,200 a year to $4,800 a year in just 3 years. Yeah, that's a 400% increase, an extra $300 a month for the exact same house. At first, I was just angry. I thought, this has to be a mistake, but it wasn't. What I uncovered is, well, it's a silent crisis that is fundamentally breaking the promise of homeownership for millions. And this isn't just about an expensive bill. It's about the systematic implosion of a market we all rely on to protect our most valuable asset. And you absolutely need to understand what is happening, because it's either coming for you or it's already here. So what on earth is going on? The simple answer is that the world is becoming a riskier, more violent place, and insurance companies, they're running for the hills. The engine driving this chaos is our changing climate. And we're not just talking about more storms or hotter days. We are talking about a fundamental rewriting of the rules of nature. I mean, think about the wildfires in California. These aren't your grandfather's forest fires. They are ferocious firestorms that create their own weather systems and can erase entire towns in a single afternoon. The 2018 Camp Fire, which devastated Paradise, California, caused over $16 billion in damages. Insurers paid out claims until their reserves just bled. Then you look at the coasts. Hurricanes are becoming supercharged, intensifying at terrifying speeds and carrying, biblical amounts of rain. Hurricane Ian in Florida in 2022 wasn't just another storm. It was a $113 billion catastrophe. For an insurance company, it's a mathematical nightmare. Their entire business model is built on predictable risk, right? On collecting small premiums from millions to pay for the predictable losses of a few. But what happens when the losses become massive, widespread, and frighteningly unpredictable? The model shatters. And here's a pattern interrupt for you, a truly bizarre detail. Scientists now track, get this, zombie storms. Yeah. These are hurricanes that make landfall, lose power, are declared dead, but then they drift back over warm ocean water, regenerate, and strike land again. How do you price an insurance policy for a storm that can come back from the dead? You charge an astronomical price, or you refuse to play the game at all. And this new reality is hitting people like you and me with brutal force. It's that gut punch feeling when you open a renewal letter and see a number so high it feels like a typo. You've been a perfect customer. You've never missed a payment. But the world outside your window has changed the math, and now you're the one being forced to pay an impossible sum. But what happens when you can't? Or when the company decides they don't want your money at all? Well, that brings us to the next deeply alarming phase of this crisis. So, when a business is losing billions of dollars in a specific market, what does it do? It leaves. And in the world of insurance, this is happening at a scale that is threatening the entire U.S. housing market. We are witnessing an unprecedented retreat of major insurance carriers from entire states. And these aren't small regional players. We're talking about the giants. State Farm and Allstate, two of the largest insurers in America, have stopped writing any new homeowner policies in California, citing wildfire risk and runaway construction costs. Farmers Insurance put a strict cap on their policies. It's even more dire in Florida. In the last few years, over a dozen companies have either pulled out of the state or been declared insolvent. Think about the gravity of that. They would rather go out of business entirely than continue to insure homes in Florida. And Louisiana, a state perpetually in the crosshairs of powerful hurricanes, is in the same sinking boat. So why is this happening? It's a toxic cocktail. You have the massive catastrophe losses, sure, but you also have exploding reinsurance costs. Reinsurance is basically insurance for insurance companies. It's how they protect themselves from a single event that could bankrupt them. In early 2023, the cost of that reinsurance for property skyrocketed by as much as 70%. Guess who ultimately pays for that increase? You. But here's the truly insidious part that most people don't experience until it's too late. When these carriers leave, they begin a process of non-renewal. This means that when your annual policy is up for renewal, they simply send you a cold, corporate letter stating, "We have decided not to renew your policy." You are given 30 or 60 days to find new coverage in a market where no one wants your business. Imagine the sheer panic of that. The American dream of a safe, secure home is suddenly hanging by a thread, all because of a risk calculation made in a distant boardroom. It's a feeling of complete and utter powerlessness. So where do these millions of stranded homeowners go? They are forced into a government-run system that was never designed for this, a safety net that is itself on the verge of collapse. So you've been dropped. You frantically call a dozen agents. The answer is always the same. Sorry, we're not writing new policies in your area. What do? You are funneled into something called a FAIR plan. FAIR stands for Fair Access to Insurance Requirements. These are state-mandated programs that act as an insurer of last resort. They were created decades ago to provide bare-bones coverage for individual high-risk properties that no private company would touch. For most of their history, they were a tiny, obscure corner of the market. Today, they are exploding. In California, the FAIR Plan's policy count has more than doubled in just a few years, now covering over 350,000 homes. In Florida, their equivalent, Citizens Property Insurance, has ballooned to become the single largest property insurer in the state, with over 1.4 million policies. This was never the plan. A last resort safety net has become the primary provider for an entire state. So, what's the problem? A backup is a backup, right? Wrong. This is a deeply flawed system for 3 critical reasons. First, FAIR plans are wildly expensive. By law, they are designed to be more costly than private insurance to push people back to the private market. But when there is no private market, homeowners are simply trapped into paying these punitive rates. Second, the coverage is terrifyingly inadequate, and this is the part that should genuinely scare every homeowner. A standard FAIR plan policy is often just for fire. That's it. It might not cover theft, it might not cover water damage if a pipe bursts, and most critically, it almost never includes liability coverage. This means if a guest slips on your steps and sues you for $500,000, your FAIR plan covers zero. You are personally on the hook for every last cent. To get that liability protection, you have to find and buy a second separate policy on top of your already expensive FAIR plan. It's a logistical and financial nightmare. Third, these plans are a ticking time bomb. Florida's Citizens Plan is now so massive that experts warn a single powerful hurricane could completely wipe out its financial reserves. What happens then? The plan has the legal authority to levy special assessments, a fancy word for a tax, on nearly every insurance policyholder in the state to cover the deficit. That's right, you could be paying for hurricane damage on a beachfront mansion even if you live 200 miles inland and have a different insurer. This isn't a safety net, it's a trap. It offers you the bare minimum to satisfy your mortgage lender at a price that cripples your budget with coverage that leaves your family dangerously exposed. This is a heavy subject, and if you're still with me, it's because you understand the stakes. If you're finding this information valuable, please take a second to hit that like button. It's a simple click, but it signals to the algorithm that this is a conversation worth having. And to make sure you don't miss our future deep dives into the financial forces shaping your world, subscribe and ring that notification bell. And on that note, talking about these huge, uncontrollable costs underscores how critical it is to build financial control where you can. A lot of you have asked me about creating income streams outside of a 9-to-5. I'm incredibly passionate about this. I've put a link in the description to a resource that breaks down how ordinary people are building 7-figure online businesses using tools like YouTube and AI, starting from scratch. It's not magic, it's a blueprint for building a real asset in this new economy. Think of it as another tool for your financial resilience toolkit against a world of rising costs. Okay, let's now connect all of this back to the number that matters most, the one in your bank account. Let's bring this down to brass tacks. My insurance premium went up by $300 a month. That's an extra $3,600 a year. For the average American household, that is a catastrophic, budget-breaking event. When you buy a home, you budget for PD, principal, interest, taxes, and insurance. For generations, the I was the smallest, most stable part of that equation. Today, it's a volatile monster. That extra $300, $400, or even $500 a month is effectively a second mortgage payment. It's a shadow mortgage you never agreed to from a lender you never met, with an interest rate that can quadruple overnight without your consent. Think about the ripple effects. A family that was approved for a $400,000 mortgage 2 years ago might be denied that same mortgage today, even with the same income and credit score. Why? Because the lender has to account for this new gargantuan insurance payment, which wrecks their debt-to-income ratio. The rising cost of insurance is directly shrinking your purchasing power. It's strangling the dream of home ownership before it can even begin. This is a targeted attack on specific regions, coastal communities from Florida to Texas, the wildfire zones across the West, and the floodplains of the Midwest. A study by researchers at Florida State University found that a 10% increase in insurance costs leads to a 4.6% decrease in housing prices. This crisis is actively eroding your single biggest source of wealth, your home equity. This is not a theoretical problem. I got an email from a viewer in Louisiana, a veteran on a fixed income. After his longtime insurer dropped him, his premium shot up to over $6,000 a year. That's $500 a month he doesn't have. He told me point blank, I now have to choose between paying for my heart medication and paying for my homeowner's insurance. This is the grim reality. The very thing you worked your whole life to achieve, your home, can suddenly become the anchor that pulls you under. So, are we just helpless? Is there anything we can actually do? It's easy to feel defeated, but you have more agency than you think. You have to shift from being a passive bill payer to becoming an active risk manager for your own home. First, shop your policy every single year. Do not just let it auto-renew. In this market, loyalty isn't rewarded, it's exploited. Get quotes from at least 3 to 5 different companies and make sure you use an independent insurance agent who can access multiple carriers. One afternoon of work could literally save you thousands of dollars. Second, strategically raise your deductible. The deductible is what you pay out of pocket before insurance kicks in. Raising it from, say, $1,000 to $2,500 or even $5,000 can dramatically lower your premium. Now, this is a calculated risk. You must have that deductible amount saved in an emergency fund, but it allows you to self-insure for small issues while keeping coverage for a true catastrophe. You're taking on manageable risk to lower an unmanageable premium. Third, and this is the most critical long-term play, mitigation. You have to make your home a less risky, more attractive bet for an insurer. In a hurricane zone, that means hurricane shutters, a reinforced roof, and a wind-resistant garage door. In a wildfire zone, it means creating defensible space by clearing flammable brush at least 30 feet from your home and using fire-resistant siding. A friend of mine who is an insurance underwriter once told me something I'll never forget. He said, "We're not sentimental, we're mathematical. Change your math." Many states now offer grants and tax credits for these upgrades. Florida's My Safe Florida Home program is one example. Look them up. This is an investment that can pay for itself in premium discounts within a few years. These steps won't solve the global crisis, but they are your shield. I wish I could wrap this up by telling you it's a temporary problem, but every expert I listen to, every serious report I read says the exact opposite. This isn't a storm that's going to pass. This is the climate of the new reality. The First Street Foundation, a nonprofit research group, has developed stunningly detailed models to predict future climate risk, property by property. Their conclusion is chilling. They estimate that a quarter of all properties in the United States already face significant climate risks that are not yet reflected in their insurance premiums. They call this a massive insurance bubble that is poised to pop. What does that mean for you? It means the crisis is spreading. Florida and California are not the exception, they are the preview. We will inevitably see more government intervention. More states will be forced to expand their unstable FAIR plans. But the more profound change will be to the financial architecture of homeownership itself. I mean, how can a bank issue a 30-year mortgage on an asset that could become uninsurable in year 10? The very idea of the 30-year mortgage is now under threat. This isn't just about money, it is about the erosion of choice, the death of a certain kind of American dream. The dream of retiring to a beach house or a mountain cabin is being replaced by a cold, hard calculation of risk. Your future may be determined not by where you want to live, but by where you can still get insured. To wrap this up, the dream of homeownership is being quietly strangled by the rising tide of insurance costs, driven by a changing climate. It's a hidden crisis turning dream homes into financial nightmares, forcing families into flawed safety net plans, and fundamentally reshaping who can afford to own a piece of America. So I want to leave you with a question to think about. After hearing all this, what is your bigger concern? A, the rising cost making your current home unaffordable, or B, the fear of not being able to buy a home at all in the future? Let me know A or B in the comments below. I'm genuinely curious to see where you stand. Thank you for your time and your attention today. Stay safe, stay informed.